All right.
Well, good afternoon, everybody, and welcome to the pre-Thanksgiving bull session. My name is Mark Robertson. I'm joined here by Ken Kavula, Kim Butcher, and Hugh McManus. We've got a Thanksgiving Grand Slam for all of you. And we do want to basically extract a few questions. It's a little bit of an unstructured program, just basically throwing some questions out and fielding some opinions and answers from our group. I'm going to throw one book on the Bull Library thing, but we're going to keep doing that going forward. And just wanted to say thanks to all of you again, attendees and the other contributors on the line for the conference last week. It was a pretty good time, Wednesday through Friday of last week. All right, so I actually have been, for those of you that have requested slides and haven't heard back from me, I've been out of pocket, off the grid, in fact, because I left my power cord in Michigan and didn't, we're talking boondocks out in northwestern Illinois. I went out and settled some estate stuff. You may recall a couple months ago I complained about being a real estate agent part-time for a few days, and we did finally sell Mom and Dad's house. The picture to the left is actually above the parking place I pulled into when I pulled up at the credit union to go and take care of some of the estate stuff. And that's the movie theater in town, and I'm not sure why it has that added message on it, but it seemed kind of appropriate. Dad was such a force. I know some of you are tired of hearing about him, but I'm not tired of talking about him. He's the reason that I'm around. One of the two reasons I'm around, and he was quite a stabilizing force in the investment world, believe it or not, too, in terms of helping me understand how to help people, and it really was a great run. The second notch there is, of course, the Norman Rockwell Thanksgiving slide there. I'm going to wish everybody a happy Thanksgiving in advance. There will not be a bull session next Tuesday because of travel requirements, plus everybody's going to be working on the dressing and stuffing and all that kind of stuff anyhow, getting ready for Thanksgiving. Hope everybody has a safe and joyous Thanksgiving holiday. We'll spend a few minutes here talking about the conference, fielding some questions, and like we say, we are still working on the library. Any comments or questions from you guys?
No, I'm thoroughly enjoying finding new books to read.
Yeah, I have a pile now. All right, let's go ahead and get the disclaimer out of the way so that we can get down to business. I do see a few new names on the list. Most of you are returning audience members. Welcome back. And a big welcome to those of you who may be joining us for the first time. We do keep it fairly informal. You can interface with us through the questions tab, or if you have a microphone, you can actually raise your hand and we'll open up both ends and basically play amateur radio here at the webcast. No investment recommendation is intended. This is all about educational demonstration. It's illustration. We basically are talking about the methods, techniques, philosophies, all that stuff, the analysis techniques, portfolio design and management, as we have interpreted at Manifest Investing, as we have watched and tried to learn from the modern investment club movement. That's also true for NAIC Better Investing. And really just trying to share and learn. That's what we do in this community. Opinions are our own. We generally try to disclose if we own a company that we're talking about. We do a monthly roundtable webcast that has a phenomenal track record. By the way, everybody out there, Kim, Hugh, and Ken, pat yourselves on the back. We were at 18% our annualized rate of return this morning, which is really kind of cool.
Wow.
So we get together on a monthly basis. Generally, it's the last Tuesday, and it's in the evening of the month. But this year, thanks to Thanksgiving, we've moved it to December 1st. So everybody, please make note of that. It's actually the Tuesday following Thanksgiving in this case. If you have any follow-up questions or you would want copies of the slides or basically anything, send an email to markr@manifestinvesting.com. I promise I'll be caught up in a couple of days. I had been keeping up pretty well while I was on the road as best I could with my cell phone, but I actually had 800 emails this morning in my inbox. Just amazing. You guys are prolific out there. All right, we started this a few months ago. You guys all know the drill. We have a bullpen queue of topics that we want to talk about when we get together and do this. A lot of times it can be stuff that I'm just noticing or interaction. Hugh and I talked about pharmaceutical stuff this morning. As I said, he's on the front lines of the pharmaceutical development effort going on with vaccines. So the topic could come from anywhere. Many of them come from audience attendees. Many of you have been asking about relative strength, and we're going to talk about that here today. But as you go down the list, you'll see a few things that we have been kicking around and we intend to cover in great detail at some point. Any comments or questions, Ken?
No, I'm right with you, Mark. Let's get started. It sounds like a good session today.
We got a bunch of stuff. All right, so let's talk about it. The market has been taking off. We talked last week about how the potential vaccine emerging could be part of that. Some people are happy about a divided government. There's just a number of things coming to pass. We've also pointed out in recent bull sessions that profitability seems to be stabilizing and actually bolstering and building. And in fact, many of you have written to me about noticing that in the individual stocks that we follow, that there does seem to be a recovery in progress. You may recall that last week I made a fearless prediction that this number was not in the best place, that basically value line was probably lagging and not keeping up. So let's fast forward 1 week, and I was right. So I'm going to take credit for that.
Absolutely.
Look at that drop. They're just catching up, right? On theirs. They basically update that every weekend when they send out their company analysis summary, and there's the drop. So we are now approaching. Remember, we talked a little bit about how oversold, or might we finally be overbought and getting up to where prices have recovered. And you'll notice that these levels here are now getting down towards historical lows, at least for the last 20 years. So yeah, it's been a little harder to find a stock in the buy zone.
So Mark, I want to understand the methodology on the graph. So the dots are monthly dots, right?
It's actually quarterly, I think.
Quarterly dots. Okay, right. So the last dot is not really a quarterly dot. The last dot is like a 9-week dot or a 6-week dot or something like that.
Yeah, it floats around until we actually get to December.
Until the end of the quarter. Okay, so that's why that dot is moving when everything else is staying consistent then, right? Because really it's a work in progress yet.
That's correct.
Okay, will that green bar also be a work in progress, Mark?
It is.
Okay, so
until it locks in on the last day of the quarter.
The fact that it's touching the trend line right now does not necessarily mean that it'll end the quarter by touching the trend line, right?
That's true.
Okay, I just wanted to understand what was a work and what was fixed on this particular graph. Okay.
Ken is always keeping me honest. I appreciate that. Yeah, in fact, my prediction, I mean, for what it's worth, would be that the green bar is probably going to head north for the reason that we're going to look at a few reasons for that here in a minute. Any other questions or comments?
Well, I'm heartened that it's gone back to trend. I really feel good about it going back to trend because that's been the thesis that my clubs and my wife and I have been operating on ever since March. And the thesis is that by the end of 2020, maybe by the first quarter of 2021, we will have seen the worst of COVID for most of the companies that were impacted by COVID that have been allowed to regain or rebuild or reopen or whatever you want to call it. Now, that does not include the airlines and the cruise ships and those types of stocks yet, but it does include a lot of the retailers and some of the restaurants and things like that. So I'm very heartened to see that thesis that we put in place 8 months ago is still kind of speaking speaking truth to my eyes, at least, if not following through with everything else at the moment. I know there's a lot of gloom and doom out there right now because we don't have a stimulus bill and everything else, but I see glimmers on the horizon, and I'm pleased to see them.
Yeah, there seems to be plenty to be thankful for. In fact, I noticed a statistic this morning that Disney is actually approaching its all-time high. I mean, think about that. I mean, who would? I don't think any of us predicted that, but we were hopeful that it would certainly happen in the not too distant future.
Well, and it's a reminder to us also, isn't it, that the stock market is a forward-looking mechanism, and it's trying to look ahead 6 to 9 months and predict what's going to happen. We seem to be getting more certainty in that look ahead period than we had, say, 6 months ago.
Mm-hmm. All right, here's one for Hugh. This actually comes from 361 Capital. We'll look at a few more slides in a minute, but I wanted to, I always like context. And Pfizer came out with the announcement of a 90% efficacy last week, and that's what's shown by this red bar. And Hugh had told us either last week or a couple weeks ago how special the efforts and initiatives that are happening are going on. And it's my understanding that Moderna's come out with an efficacy even higher, somewhere out in this range, 94, 95%. And Hugh, could you put that in context for us? I mean, there's polio on this slide and hepatitis and all. This is like a laundry list of things that none of us want.
Yeah. No, it's a remarkable number. And, once you get maybe 2/3 of the population that are vaccinated, it's game over for the virus. It effectively pushes what's called the R0, the number of people on average that you would, a given person would infect, pushes that below 1. Once it goes below 1, it's not going to be a pandemic anymore. It won't spread. It will have to mutate if it wants to survive.
Yeah, no, I mean, looking at this chart, I mean, I highlighted that the flu, influenza, it isn't really even a vaccine as I understand it now. I mean, look how far off the chart that is to the left.
Yeah.
So there is hope that even that. I was listening to a commentator last night on the ride home he sounded a lot like you, Hugh, when he was very optimistic that there would be, in fact, I think you used the word extrapolations that would have impact on other potential areas.
Yeah, well, it's accelerated efforts in RNA vaccines and validated those, which is kind of a brand new area and does hold out hope for a vaccine for something like the flu. But both of the two leading contenders are what they call RNA vaccines.
Including Moderna, right?
Yeah.
Okay. All right. So that's,
I'm surprised, Mark, by the shingles and the pneumococcal vaccines being under 70%. Those are two that, from my doctor's standpoint at least, are surefire hits if you get them. When I hit a certain age, those were two shots that I was encouraged to get because it would stop those two diseases dead in their tracks. So does under 70 just mean it takes a longer time to develop the herd kind of immunity, or is 70 just still a really good number?
Well, it is a good number, but I'm wondering, does it mean that it's not effective in 30% of the people who get the vaccine? I didn't realize that's the case, that the number's that low. What I'd be really worried about is rabies. I thought the rabies vaccine was 100% effective. I must look into that, because rabies is a death sentence if you get it. That's very few people get it, obviously, but rabies is a horrible thing.
Yeah, and having done shingles personally, I'm there to tell you, if you can avoid it, you want to avoid it. It's a tough one. All right, so let's go ahead and talk about a couple other things that we do see happening. Ken was kind of foreshadowing this a few minutes ago. I just threw some slides from 361 Capital on the page for us to look at. Goldman Sachs is pretty optimistic about the next couple of years. Ken said that just a few minutes ago. I do find it kind of interesting that we have talked about Japan here in recent weeks, and Japan is back at 30-year price levels, finally. So just something to keep in mind that we had kicked around. The other thing that's kind of interesting is the bullishness of investors. Yeah, they're at levels we haven't seen since right after the tax cuts a few years ago. That would be this one here. And then the other one, which I think is even more compelling because that money's got to go somewhere, is the fact that savings deposits are at a record high. And I was looking at working with an investor that had a relatively large amount in cash. And, you know, I'm a math person. And I was absolutely stunned to see this very large balance with like $4 in monthly interest. I mean, we're talking a 7-digit cash balance, and it was like $4.89, and I'm like, oh my! It literally sucked the life or the breath out of me for a minute. So
ask those of us that are 10 years older than you about the money that cash generates in regular accounts. I mean, I'm looking at sizable cash balances in some accounts too, and it's sitting there because it's just there. We don't need it, and it's there. But you're right. $4, $6, $7.12. Those are very common returns, Mark.
Well, I was talking with a colleague, and she is literally rolling around the floor laughing as I'm describing the specifics of the situation, because I don't do a lot of cash equivalent type investing, you know, if you want to talk about it that way. So I had to turn to somebody who actually does this stuff more to get a feel for it. And I guess I just didn't have the appreciation. So Ken, maybe I'm just too young. I don't know.
Well, I didn't hold this kind of cash, Mark, 10, 12, 15 years ago, but I'm holding it now. And you just need to get a little bit more seasoning on your plate here.
Yeah, balance preservation, huh? So
Yeah.
again, the point is, when you hear that stuff about money being on the sidelines, cash on the sidelines, I don't think it's mythical. I think there's a lot of reality to it. There's other slides that talk about inflows to mutual funds and that kind of stuff, but that's where I think the pressure, the optimism, the pressure, the forward-looking nature of the stock market itself that we talked about a few minutes ago, all of that adds up to, it's, you know, just like it's always a good time to be invested. This one's probably a pretty good one coming out of what we've been through.
I think, Mark, it's a reaction to a lot of baby boomers also that don't have, in some cases, the depth of family. I mean, our generation didn't all marry, and we didn't all have, scads of children and everything. And I manage money for my sister, and even though I've tripled her money in her investments since her retirement, which was about 7 years ago, she insists on holding a huge portion of her portfolio, as much as 35% of it. She insists on holding things that are completely liquid and she can touch the next day if she wishes to. So
I get it.
I think it's part of the psyche of this generation that is beginning to age past 65 now and is thinking about their own mortality and thinking about the expenses of going into managed care of any kind.
Mm-hmm. Learned more about that than I cared to recently too. All right. Well, Ken, I think we'll just take a moment and reminisce a little bit about some of the sessions. I've gotten a humongous number of requests for slides, a lot of very, very affirmative feedback. And before you came on the call, we were just chatting and people were talking about how it's kind of cool to have a couple of these events per year. That's what it kind of comes down to. And they, hey, guys, I warned you that we might have to talk gently to Ken on this. Kind of like talking about the next baby in the maternity ward. You got to be careful with
Yeah,
that.
we need a couple of weeks yet before we can even talk about doing another one of these again,
But
Mark.
they did. The audience, a couple of the audience members talked about it as being a booster shot, and that certainly aligns with our vaccine discussion also. So I think the sessions went off pretty well. Like I say, I'm distributing a large number of the slides, but there's a number of people that are writing on projected return on value, and it's kind of a epiphany moment for some, and it obviously we'll continue to build and test and check that for utility, utility to us as a community of investors, and that's what we're after.
Yeah, well, we did see a drop off in attendance from our May sessions to these sessions, but still we had audiences much greater than we could ever touch in one place in person. And that makes, I think, it all worthwhile. Our audience were akin to what you could touch at a convention on a good year. And I think that when you and I speak around the country, it's great to talk to people and shake their hands and sit at the table at lunch and do bull sessions, essentially. But we can't reach the numbers that we're reaching when we do a conference like this. I sometimes wish that we had a little bit more ability to publicize these things, but I think we're doing pretty well with the limited publicity that we're able to do with the lists that are available to us.
Well, if and when we do the next one, and we were talking before you came on, Ken, about there's quite a few things already being canceled or postponed through June of next year. So I would think that the national convention is, I don't know anything. I already said that. I have no information other than personal opinion. That's probably already somewhat in jeopardy.
Well, we had a Ticker Talk meeting yesterday, getting ready for our Ticker Talk that's coming up on, when's it coming up? It's coming up tomorrow, folks. There's Ticker Talk tomorrow. If you haven't signed up for it, please do. But the three of us didn't know anything about the politics of the situation or anything, but all three of us thought it was at best a 50-50 chance that convention would happen in May. We were all rooting for somebody to have the foresight to maybe move it to September or October. We used to have conventions in the fall quite a bit. We moved them to the spring. They worked out well in the spring as well, but maybe by September, October this coming year, we'll have clarity in where we can go and who we can go with.
And if that happens, you could be looking at COVID cancellation conference 3, but I can't mention that in front of Ken right now.
No, Mark, we have a hand in the air. It's Roy, our friend from Sacramento, Roy Chastain.
Hey, Roy.
So, Roy, I'm going to unmute you, and I'm not going to unmute you, Roy. You're self-muted. So unmute yourself and speak, Roy. There you go. Oh, we're having some audio.
There we go. There we go.
There you are. Okay.
I just had a question and a comment. I'm going back to the vaccines and the shingles. A few years ago, I had it, and my doctor got it at day 3, and she said she could give me a shot for it, but if it had been 2 or 3 days later, it wouldn't work. It worked very well for me, but I wonder if that's why the numbers were so low, because if they were looking at people who got shots later and it was ineffective. The other thing is I just started the 2-shot protocol, and that they tell me is like 100%. So I wonder if that's even incorporated into that shingles number on the graph.
I was wondering some of the same things, Roy, that the 2-shot is definitely different than the single shot that came out, I don't know, 10, 12 years ago. And the same thing's true about the pneumonia. There's a shot for folks over a certain age that's extra strength too. And all I have to think is that it's extra strength because it contains more strains and maybe because it has something new and improved working for it as well. Appreciate
Yeah,
your input, though.
they loaded me up, and just a comment. You're still a kid, I guess, if you're a baby boomer. I'm a pre.
Okay. I'll take that. Thanks, Ray.
That's why Ken used to hang out with all of those 60-year-old investment clubs in Midland, Michigan. Because they, what they call you, Sonny or something like that?
Yeah, Sonny, the young guy. Sonny, yeah.
All right, let's go ahead and peel off a question, a topical question that many of you have asked about, and something that we can dig into for just a little bit here today. It has to do with the relative strength index. I'm not a technician. I don't believe in many of the things that technical analysts do, but we have found a limited amount of utility in the relative strength index as a technical indicator. So we want to talk about that. And this actually comes from an attendee at the conference last week. And he has a few stocks that are at or around 70 on the relative strength index. We'll define that here in a second. And he had bought some following the conference back in May. And it actually added a couple of companies following the sessions last week. And they're all up in that 70 range. And notice that he did buy Stone, I guess it's Stone Co. That's the one that's up a few 100% since May. And it's now got an elevated relative strength. So does Ambev or Bud. And again, many of the positions we talked about last week are down in the 30s, 40s, and 50s. In fact, I did a screen for companies that are intentionally down in the low. And, you know, are these 70s worrisome? How aligned are we with RSI? What do we think of it? Is the 70s scream sell? And I don't think so. I think it just means be more vigilant. Could be an opportunity to do a partial sale or that type of thing. But let's put it in context a little bit, and we can come back to these questions and flash some answers at them. Here's a short list of the stocks, and I wanted to include these are not a short list. These are the May stocks that were selected, including the Stone Co. that he had mentioned here. And notice that it has gone up from 22 to 67, so that's a really hefty gain. And the relative strength index is in that 70 range that he had mentioned. And then he's also mentioning some of these companies like CBS. I had no idea the relative strength index was that high on CBS. We'll take a closer look at that one. But he's just wondering about some of these that are a little bit higher. Axos down here at 73, even Toronto Dominion, even the stock that was presented by Pat Donnelly, Hannon Armstrong, which has a very interesting looking situation. You know, how do we regard that? What do we think about that? So in order to do that, let's take a closer look. We can come back to this list if we need to and actually define it. Here is a chart via stockcharts.com that shows the stock price activity or action for the last 6 months. And the relative strength index, when we display them at Manifest, is this up here at the top. And you can see that the scale on it ranges from 0 to 100, but you can see that the demarcations are actually 10, 30, 50, 70, 90 over here. So anytime a stock gets overheated and has run up considerably, you get this green shaded area above 70. And that's what it's talking about down here. It's considered overbought. In other words, perhaps an over-enthusiastic crowd of investors and traders and speculators kind of chasing it and pushing the price higher and higher. Again, think supply and demand, pushing it higher and higher, versus a time when it could be considered oversold or a real buying opportunity during times like this, that's shown kind of in the middle of the chart when the stock was down in that mid-50s range with respect to the price. So I think everybody here can see that since November 1st, roughly, it's gone from 56 to it actually hit 74. That is a pretty rapid run. And that's what accounts for the relative strength index being at, in this case, it got up almost to 80, and because of that really rapid price increase. And again, that's suggesting that it could be at least temporarily overbought, and that we shouldn't be surprised by the possibility that it would actually relax and come back. And in fact, it's lost today. I believe that's $8 a share today, as of this morning. So, I mean, does it happen all the time? No. Things can stay overbought for a long time also. And one of the things that we have discovered over the years is that it probably makes a whole lot more sense to maybe ratchet up to a number like 80 or 20 on the other side when it comes to judging overbought or oversold. All of this text comes from this article at Stock Charts, and those two little inserts actually come from that, and that'll actually tell you the entire history, how it's actually calculated, how some people are using it, and you can just become educated on what it means. I kind of use it as a tiebreaker. Ken used to actually put his fingers together in the shape of a crucifix and try to ward me off anytime I tried to talk about this. I think he's gotten beyond that stage. Is that an accurate characterization?
I'll tell you what I'm using RSI for, Mark, and I've been using it this way for maybe the last 2.5, 3.5 years. I've been using it as a check, and as a check against an SSG that says sell. I've noticed in the last, again, 2.5, 3.5 years, I've noticed that I tend to write two different kinds of SSGs. I tend to write very conservative SSGs for public consumption, and many times I tend to write SSGs that are a little bit out there when I'm investing for myself or with my wife. So sometimes my sell decisions come a little bit quicker than I would like them to come if the SSG is a little bit on the conservative side or a lot on the conservative side. So as soon as an SSG flashes sell or gives me something that's very close to a sell, I will go to the RSI, and if the RSI confirms that sell, then that's giving me ammunition for pulling the trigger. Many times on the conservative SSGs that I write, I'm looking at a company with an RSI of 55, 60, 65, something like that, even though my SSG is selling sell. And that's when I might wait until it hits 80 or even higher before I get that confirmation that I really want to pull the trigger.
So you're saying on the buying side, these 50s and 40s and 30s are things that you like to see. You don't need to see them, but you like.
I don't need to see them, especially on the buy side. I'm more inclined to buy a stock that is a little bit in that 2.8 to 3.2 zone of upside downside, knowing that I'm going to hold it for the long term, and if I miss the price by $5 or $6, or maybe I should say 4 or 5%, if I miss the price by that, I still have the opportunity to make a nice return on the whole thing. But on the sell side, I am using RSI as a validator of my own SSGs.
Mm-hmm. Now, I will confess that I've paid a lot more attention to the 80 since our discussion with Ray Rondeau, and I'll bring that up here in a minute and talk about that. Last summer, I think it was, when we were talking about Cognizant and just interpretation of the relative strength index, and I'll show everybody where to go so that you can at least digest that conversation. And the other area that it comes in for me, and this one's for Hugh, sometimes Hugh brings very unusual stocks to us. Sometimes they don't even have earnings and that sort of thing. And in the absence of a stock selection guide, when I'm speculating, again, with that tiny part of my portfolio, because I still sleep at night, even though I have some Hugh McManus stocks in it, I will use the relative strength index almost exclusively for those sometimes. And it's just something to think about.
Well, Mark, as a counter argument, I noticed that BP has a relative strength right now of 67 or 68. Did I read that correctly?
Yeah, but it was a lot less than that recently.
Yeah, so I'm just suggesting that even though it's really over priced, and it still might be trading down near the 52-week low. It has a pretty high relative strength, and that would lead me to move away, not towards the stock. I guess I have to hear from another voice as to why that relative strength should be ignored at this point.
Yeah, and that actually leads into this perspective, and we talked about this, and those of you that want to go back and digest the conversation, including some of the commentary from Ray Rondeau, who's a technician, and he does some work for the American Association of Investors, is to think more like an investor, not like a trader. When we're looking at this chart, we're thinking closer to a day trader. It's a daily chart, which you notice the phrase daily here, and then this number 14, that's the look back period for the math. And so they're only looking back at a couple of weeks of information, and they're looking at a daily situation to come up with that relative strength index. When you look at it from our perspective, and frankly, people on Wall Street and especially not day traders, they would probably have convulsions over this chart. It's first of all, it's 10 years, it's monthly, and the relative strength index here is based on a trailing 12 months. And for an investment versus a speculation or one of those general market securities, for an investment, I'm more likely to look at this type of chart. And notice, the stock price action on CVS has been quite strong in the context of a 10-year price chart here. So again, I would encourage everybody to go back and check out that Cognizant Nation. It's actually a thread on our forum, and there's also a YouTube video. If you go back and check it out, it's been one of the more popular archive recordings, and frequented quite a bit on the forum. So again, the time period and the look back period are an important consideration, and as an investor, I'm going to look at that to give me some more advice on and perspective on the situation. All right, this one is kind of fun. I thought I would embed a look at a chronicle, a longer-term chronicle, because some of you have asked about the chronicles that have come up in the roundtables and at some of the presentations over the last week. And all a 10-year chronicle is an extended version of the one that's on the site. And think of it as a snapshot. In this case, this was Cognizant Technology. This is actually from that thread that I just mentioned right here. So you can go back and see a little bit more about it. All a chronicle is a picture of a bunch of snapshots of the companies, points in time. In this case, I believe it's monthly. Well, those are actually quarterly. And so those are quarterly snapshots showing the stock price first, the green bars, and the red is the projected annual return over time. So stock prices fluctuate, so do the return forecasts or the PAR. And in this case, this was a pretty good buying opportunity in the history of Cognizant. Look at the price levels. And in this particular discussion, we were talking about the fact that the technical indicators had actually turned fairly negative, and there was some stuff going on at the company. In fact, this was what was called a death cross moment, and we don't need to go into it today, but it's just something that the day traders and the speculators notice, and it can be a pretty nasty moment for the stock. And just the opposite of a death cross moment were golden crosses. And I want you to notice that these were two pretty good times to perhaps assume ownership of this particular company.
Mark, I'm going to answer a question from Sudip here because it pertains directly to what you're talking about. He wants to know, where would you find that discussion on Cognizant that you and I had? And it's on the YouTube, right, it's on YouTube. And you go to the Manifest Investing channel on YouTube, and it's listed under one of our discussion projects that we've been doing. If you were to search on Google and not only put in manifest investing, but put in cognizant discussion or something like that in your search engine, it would take you directly there. But it's definitely on the manifest investing website, and Mark is trying to show it to you right now.
Yeah, if we just go to just to put in the ticker symbol after manifest investing, I'm pretty sure we'll get it. And if not, we can show you that too. These are just discussions where it has come up. So let me go back to the top of the page. All I did was...
Well, is that it right there, Mark? Investing topics, cognization?
That's it. I found that I noticed that I found it. So if you go to YouTube and enter manifest investing, CTSH, what you will get, well, here's obviously an introductory piece. Here's stuff. We must have mentioned Cognizant last week during these sessions a couple of times. And then this is the one that we're talking about here. It's actually had a fairly good number of views. But you can see from the introduction, the stock price was down. There's a new chief executive, a global recession hitting. And we basically had that discussion about, what's going on at Cognizant. So if you search, you can find that that sort of thing. Does that take care of that one, Ken?
I think so. Yep.
So that's where you can find it. That discussion was going on. Let's see, what time was that time frame? Excuse me. Back in the middle of 2019. So as the company had started to slip a little bit. And remember, we had that discussion of, this slippage that we're seeing right here at the national convention. And there were a number of discussions that took place leading up into this. So we're actually talking about the company right in this time frame. And notice how deep the corrective moment was in early 2020. So again, here's a situation where it was pretty oversold, overbought back in this time frame. According to the chart, things can stay overbought for a long time. Notice that it's kind of bubbling up into there all along the way. This was one of those moments, in theory. Didn't get up to 80, but it did get up to over 70. And I guess the much like Ken was saying a few minutes ago, it's not going to drive me to action, but it's going to flag, and I'm going to probably take a little bit more diligent / vigilant look at the company under those conditions. I do know that I sold off some Cognizant back in that time frame. I know I did. I witnessed investment clubs basically selling off some of the Cognizant in that time frame, and who knows? I mean, they definitely protected themselves against this, but the company is beginning to recover. And here it was a theoretical buying opportunity. Again, look at the price levels. So it's
Mark. I'm going to unmute Sudeep. He's been right in the middle of this conversation. Let's see what he has to say, okay? Sudeep, you're self-mute. There you go. Go ahead and speak.
Hey, Sudeep.
Oh, I'm sorry. I thought I lowered my hand. The demo was very helpful, Mark. That was very nice that you could show that, and I'm looking forward to going back and looking at that. No, please continue.
Okay. I think you'll enjoy that if you take a look at it. I know you've been watching that kind of stuff for quite some time.
Yep, that would be great.
All right, let's move along then. Here's the power of the RSI for me. It's one of the reasons that I presented the low RSI stocks, the ones that are in the 20s and 30s at last week's conference, because this is that moment that I have described a number of times when I was on the phone with Kim Butcher. Kim's here with us now. She can be my witness and hold up the right hand. This was back in the middle of look at the date right here, 3/26. We were right in the middle of the bloodbath when this was all going on. And I was looking for potential purchase candidates. In fact, I was trying to shepherd cash into an account so that I could actually execute some transactions. And at that time, I was going through and looking at a number of companies that had relatively low RSIs. And remember, we said below 30 is good, below 20 is great. So there's a bunch of companies here that are at levels you don't see very often. See those 20s? There were actually some that got down around 10 back in that time frame. And sure enough, I did secure a few shares of Wolverine Worldwide back in that time frame. We added Wolverine Worldwide to the Tin Cup tracking portfolio. By the way, this is Wolverine Worldwide for those of you that don't know, the hush puppy dog. That normally fairly boring company was actually a pretty compelling opportunity at the time. And just noticed that the general levels here are all pretty good. And I was excited and trying to shepherd some cash. Ken has already heard me whine about this a few times.
You and a hot dog.
I made a hot dog slide for today. I mean, I'm on the phone with Kim at like 11:30 in the morning, and I think we were looking at Wolverine Worldwide and a couple others. I went away to make a hot dog, and it was a microwave hot dog, and it came back down, and the stock that we were looking at had gone up like $10 in the 15 minutes I was upstairs. And the point I'm making here is all of those low relative strength indices that were happening back there on March 26th, notice where the prices have gone. I mean, Wolverine went from 14 to 28. Thank goodness I was able to get some of that one. But in general, these are all pretty strong numbers. So,
I think you and I, Mark, looked at when S&P Global got fined by the government.
yeah,
It was
that's
at
right.
120 and it went down to 79, I think. And I think I presented it at the round table, and then I think it went up 50 or 60 bucks.
Yeah. So,
It is something to use in your arsenal of helping you pick a stock.
yeah, so in this case, just think about this moment in time. I'm sitting there looking at these stocks that are all potentially oversold and buying opportunities. And you just go through and cherry pick the ones with the higher quality, find a good looking stock selection guide. Pat Donnelly and I actually debated OMAB back at the time. I don't even know what this company is, but these are excellent quality ratings. And again, I'm just making the point that if a relative strength index is low and you're triggered into doing a full-on stock study, and that all looks pretty good, those are a lot of things lining up in your favor, in my experience. And
Well, Mark, if you'd quit making hot dogs with 37 ingredients on top of it, like this one shown here, this Chicago hot dog here, you'd have more time to buy the stocks that you wanted, you know?
there's no ketchup on that hot dog.
You got tomatoes on there.
Yeah. So anyhow, that's the message. The relative strength index can be an indicator in both directions. I tend to look at it as a shopping opportunity on the front side, a very low RSI. On the other end, it can be just simply a clarion signal to nudge you into possibly maybe selling a partial position or selling the whole thing. And you heard us mention, I think during the conference, we talked about the Pat Donnelly rule. It's actually a guideline for StoneCo. StoneCo has actually been up with a relative strength closer to 90 at some point, because it's gone up 300%, well 200%, but it's basically tripled in 6 months. And for a company like that, if I am speculating in a company with a fairly short track record, great story, nothing wrong with the company, but it's gone up that much, I might actually take a partial position and sell it if I want to continue holding it, or simply go looking for the next one with the proceeds of sale. And the rule is basically if the RSI goes up to 80, we probably put in like an automated sale on this one. The reason that we have that is 3 or 4 years ago, Pat selected the company. I don't even remember the actual name of the company, but the ticker symbol was DEER, D-E-E-R, D-E-E-R. And he picked it at like $2 a share, and within a few months, it was at like $14 a share. And then, absolutely skyrocketed. And then we came back a year later, and it had gone all the way back down to like 50 cents. So was he right? And again, from the long-term investing standpoint, you can say a question mark, but in terms of opportunistic investing and being fleet on your foot with that small part of your risk capital portfolio, it was absolutely right. And so when that relative strength index crossed into 80 or 90, you simply have to protect yourself against the vulnerability of the downside, and or at least consider doing it. I mean, I don't know too many people in our audience that like to go from $14 to 50 cents on a successful investment. So again, it's just one of those things to keep in mind. It's an indicator, and definitely worthwhile. So for any of these up here, if they actually do reach relative strength indices of 80 or 90, we'll step aside, take the gain. All right. So any other comments on that? Well, I wanted to go back to the slide itself and make sure that we answered the question. Where do you find it? Relative strength can be found at Finance Yahoo, Stock Charts, the free stuff, a couple other places. I know FinViz has it. Any other favorites come to mind, guys?
Well, Mark, it's a default on the two stock charts, the big charts and stock charts. It's a default setting, so you don't even have to play with the graph. You just draw the graph, and RSI comes up on it.
So I guess our message is learn what it is, and then you can make your own judgment as to how it might serve you. And here's the discussion on Stone Co. I'd be interested to look and see what Bud has to say. Again, with Bud, I would probably be more inclined to look at Bud like we did here for the very long-term investor type perspective on Bud, and the chance that it's in the RSI greater than 70 or 80 range is actually pretty low. You can check that if you want.
Mark,
So,
I'm going to just put a tag on that second graph that you showed there. As a free user of these stock chart sites, you can't do a monthly chart. Am I right?
I think that's correct. I'm sure it's correct.
I think you're confined to shorter term charts. So just keep that in mind if you're trying to duplicate what Mark's doing. He's a subscriber to this site,
Yeah.
and I don't think you can come up with this once a month data the way that he came up with it here.
What I don't know is, can you do it on big charts?
Perhaps, I don't know. I haven't.
I will check that. I will try that, and I would encourage anybody in the audience to find a free alternative that can actually do something which would serve this purpose.
And there's one other thing I'll throw in. This is Hugh here. And that is, I mean, I've never done this, but I know that both Schwab and TD Ameritrade, as examples, two brokers that I use, have a boatload of tools that I've never touched. Particularly TD Ameritrade has a lot of tools all over the place. And I haven't even bothered to check TD Ameritrade to see if there's a way that I can even download prices from those guys or plot them in some way, I don't know. I don't know if anyone else knows, but I was so used to using big charts and the other free services that I've never really paid much attention to my own broker. And anytime I click on there and see all the things they have to offer and all the companies they've bought and get beautiful screens that make you look like you're in one of those movies that's trying to corrupt the market. There's just a whole bunch of tools there that are kind of a bit mind-numbing for me initially, but I'm just throwing it out if anyone in the audience knows.
I have a TD Ameritrade account, Hugh, and you can chart a lot of things on TD Ameritrade, but the learning curve on using their platform is a little bit steeper than you might want to have for somebody that's just starting in this stuff. It used to be that you could walk into a TD Ameritrade office and they would help you with that stuff. But most of those offices, since the merger with Schwab, most of those offices have closed, and the Schwab people are not especially aware of how the TD Ameritrade platform works.
Yeah, that's going to be interesting. All right, so I'm going
Schwab is very good at taking deposits in their defense. Just heads up on that.
So
I don't know anybody that's not good at taking deposits.
all right, so take a look at that question. I'm not sure if I, aligned. How aligned are we with RSI? You just heard 4 experienced investors with a combined investing experience of, I'm thinking 100 years or more. You can tell that we do not emphasize this, and that's sugarcoating. But can it be a tool that provides a little bit of fine tuning? I think so. Can stop making the crucifix fingers at me now for a couple of years. So it can be the type of thing. Does it scream sell? I don't think it screams, but I do think it does nudge and say, think about, how well you've done with this company, and perhaps it can be, you can protect yourself in the clinches. And again, I've lived through the experience of buying a $7 stock, writing it up to 49, and then writing it back down to 0. And anything which will help me avoid that type of thing, I'm going to pay some attention to. So just some food for thought. And those are both of the lists from the 2 conferences. You can have some fun tracking along as we go. All right. So let's just switch to this one. I think we're running pretty, I think we got time for one more. Let's talk about debt. Kenya, would you care to tackle this one?
Well, yeah, I think that debt considerations are becoming muddier and muddier as the rules for accounting practices change. And I think we have to remind each other that the 30 to 35% debt recommendation for a typical manufacturing or services company was prior to the rule changes about including leases as part of the long-term debt picture. I think that we're getting a whole lot of people now that are looking at debt numbers, remembering this advice about 30, 35%, and not understanding that the way that the debt is reported has changed, but not necessarily the load, not necessarily what companies are paying. When you factor out the lease obligations for most of the retailers, for example, you find that their debt loads are still pretty much the same as they were 5 or 10 years ago. Same thing true for restaurant chains especially, where they lease a lot of their land rather than actually buy the real estate. So on top of that, I think that the debt load has been muddied an awful lot by extremely low interest rates.
Exactly.
I'm watching people borrow money because they can make more from that borrowed money than they are paying on the interest, and they're making, considerably more from the borrowing than they're paying on the interest. And that's just I think that's smart business practices. But we've been in historical low interest rates now for a large number of years. And if anything, since the pandemic, they've even gotten lower. They're approaching, in real money terms, they're approaching negative numbers, or they're already at negative numbers. And I just think that this guideline needs to be rethought a little bit. And we still need to carefully look at debt, but I would rather look at debt in concert with all the rest of the companies that make up an industry or a peer group or a competitors group or whatever you want to call it. I think that gives me better information as to whether that debt is impacting the company. And then I also want to take a really closer look at interest coverage. I think it's an underused ratio. It's an easy to find ratio, and it's basically telling you whether the company can cover the interest on the loans that it's taking out. We look at companies that we consider blue chip. Colgate-Palmolive comes to mind. They've carried heavy duty debt for years and have never had a problem with it. And I don't think that the fact that they do carry that debt should disqualify them from consideration as one of the highest quality companies that we look at.
Mhm.
So I don't know. Add your thoughts to what I've said, Mark.
Same thing. It's true with many of the general guidelines. Emphasis on the word guideline. This was a guideline intended to protect beginning investors, and it follows along the lines of companies with less debt are less likely to go bankrupt. Bankrupt is never kind to shareholders, and so that's a lot of what is involved there. It's always been important, and I don't believe Better Investing has changed the guideline. It is important. When should debt be a concern? When it needs to be a concern is my answer. And I'll actually use it for a shameless segue. One of the things that has always intrigued me, if you go back and read the Investor's Manual from 1984, any of you guys want to speculate about where George Nicholson started discussing in the very first chapter? What did he spend all the time on?
Yeah.
I'm going to guess section 2, Mark.
Well, I'll tell you, Kim's already got it. It basically was the balance sheet, and with respect to debt and connotations for financial strength. And what's fascinating is the stock selection guide is very income statement centric. You know, the only real treatment of debt has to do with the couple of ratios and that sort of thing. And Ken, you mentioned the interest coverage, which people can take a look at. I actually prefer the effective interest rate. Tells you the same thing in a different way. But it's kind of fascinating that the stock selection guide doesn't really treat with any specificity what Nicholson started talking about in chapter 1, the balance sheet, and the importance of the strength of a balance sheet. Now, the shameless segue part is we talked an awful lot about projected return on value, and the enterprise value of the organization, any enterprise that we're studying, very carefully considers the liabilities and debt. And I think it's going to just be an interesting marriage and propagation of some concepts as we continue to deploy it. So that's my shameless segue.
Well, I want to jump on to the end of your shameless segue, Mark, by indicating that the stock selection guide has never spoken about cash on hand. It's always spoken to debt, and yet cash on hand is an important part of the balance sheet as well. And I think many times a company with a large amount of cash on hand has hidden resources that the average investor doesn't really take a look at, even though they should. And again, when we do our proof calculation, that cash in hand becomes an integral part of the calculation itself. So I think both of those values, whether you're owing it to somebody or somebody's owing it to you, I think is a pretty decent thing to have added to the whole calculation of return.
That's a great way to end the discussion. I mean, I can remember a specific case a few years ago where a person studying the company said, "But they have $20 billion in debt," and my response was, "Well, but they also have $60 billion in their checkbook." So it's not the same thing. So that underscores what you just said, also, Ken. The cash on hand really matters. All right. One of the other questions we got is the list of companies for the best small companies, and not going to go through them. There they are, at the top of the page. They're off and running pretty well. The thing I wanted to answer and bring to everybody's attention is right on the homepage, going through our published dashboards. You can actually look these up and follow along at any time you want using that public link. Okay. And I'm going to close. I'm just going to throw one more book on the pile. My colleagues took the week off. I'm just going to throw this one on the pile for now because I know this is one that, Ken, I know you've taken a look at, and I know Hugh really likes this one. So this is another multiple selection from us. The important thing about this one is, first of all, Phil is Ken's dad. And Phil is just an incredibly accomplished investor that thought a little differently than many of the people in the herd over the years. And I probably owe him the most for liberating me from this myth that you needed to have a whole bunch of companies, because he basically criticizes diversification The modern investment club movement focuses in on 12, 16, or 20 companies in most clubs, and we really pay attention to those holdings as stewards, and that's the right way to do it. Buffett for years had 12 or less investments, even though he had multi-billion-dollar positions in them, he was very concentrated, and you can really benefit a lot. It's the academics and the regulators would tell you that you're taking on far more risk. That's also not true if you know what you're doing, investing by the virtues of the modern investment club movement. So again, my debt of gratitude going into the Thanksgiving holiday is to simply say thanks, Phil, for teaching me to focus in on that. 12 to 20 companies is certainly a sufficient number for any individual or club portfolio. Any comments on the book, guys?
This is one that I've never read. Mark, do we have Arnold Bernard's The Evaluation of Common Stocks on the list?
We do, right here. We covered it.
Where is it? Okay, all right.
Covered it last
I
week
have-
with some links too.
I have an original from 1959 that my wife pulled out of my library in the basement. Do you know that this was originally nothing more than 4 lectures to a college class? And the entire book, including all the charts, was prepared by a stenographer and a clerk, doing all of the material by hand, every single bit of it, all the charts, all of the, it's just amazing to me that a book with this much substance to it was prepared before computers by people doing paper and pencil work. It's a real great book that I've started to reread, and I'm about halfway through. And it's nothing more than 4 lectures, and they're actually not that bad to read. And they're full of really great tips, really great things talking about basics and how you can use Value Line occasionally to make the whole thing work.
Well, I look forward to a future car ride because I've read that one a couple of times, and we have featured it at Manifest a few times. And you're right, there's some really good stuff in there.
Okay.
All right, so I'm going to go ahead and close down with just a reminder that all 5 sessions from last week's conference are available at the Manifest Investing channel. If you want to know when we post stuff like that, simply subscribe right there in the middle of the chart. Subscribe, and we'll let you know when we post things like that. So they are all there. I also wanted to let everybody know that if you're interested, you can actually click on playlists, and all 5 sessions are right here in one playlist. So you can, when you're starting a long drive, you can just plug us in and be entertained for the entire trip. So with that, I'm going to go ahead and use Norman Rockwell to say Happy Thanksgiving to all my colleagues and all of the members of the audience. Love you guys.
Happy Thanksgiving, everybody. We'll talk to you again on, I think it's December 1st.
Yeah, that's out of my field of view. I'm just going to go eat dressing and cranberries here for a few days. All right, take care.
Bye, everybody.
All right.